What do you call a token that erased 36% of its circulating supply, locked half of all future revenue into an irreversible buyback contract, and still trades near its lows? Most call it dead. I call it mispriced. And this week, the daily chart started to agree. Pump just broke a falling wedge that held it down since 2025, and it's now fighting the one level that decides whether this becomes a new trend or another failed bounce. I'll show you where my capital sits and the exact price where I'm wrong. Pump.fun might be the most hated revenue machine in this market. Ask around and you'll hear the same story. Meme coins are done, the token's finished. Yet this platform still ranks first in revenue across its entire category. That gap between the narrative and the data is usually where the best risk-adjusted setups hide. Price is pressing into a ceiling that has capped it all year. But before the chart, you need to see what the team did behind the scenes, because it quietly rewrote the supply equation. Here's the headline number. The team burned every token they'd bought back, about 36% of the circulating supply in one move. On Token Terminal, supply dropped from around 600 billion tokens to 396 billion. A third of the float, gone. The market barely repriced it. That disconnect is why I'm making this video. A one-time burn is a gesture, though. What matters is what they attach to it. 50% of all net protocol revenue now flows into buybacks and burns through a locked smart contract. And here's the key word, irreversible, for a full year. Nobody can pause it on a bad quarter. That's contract-enforced buying pressure under the market every single day. They spent 9 months putting 100% of revenue into buybacks, and the market still didn't trust them, because nobody knew where those tokens went. Burning them and locking the mechanism was the trust purchase. The other half funds hiring, acquisitions, and product bets, and that's healthier. A buyback from a dying company is worthless. Then the insider signal, verified on-chain. Noah, founder of the devco behind Pump, owns 4.8% of the supply. Part of that vested in July, about $27 million, fully liquid. Trackers checked all 4 unlock wallets. Not one token sold. Words are cheap, wallets are not. Now stack the product side on top. Robinhood tokens trade directly inside the Pump.fun app, no bridging, settled in Solana. A pivot toward a consumer trading app, and every trade feeds the fee engine funding the burn. They also shipped boost mode. Every year, over $100 million of liquidity dies when tokens migrate, stuck in pools forever. Boost recycles that dead capital into every bonded coin after migration, and every purchase token gets burned. A second supply sink in the plumbing. And one card they haven't played, the airdrop. The delay looks deliberate. While price sits at the lows, the buyback accumulates more supply per dollar, and the longer they wait, the further it reaches beyond the usual crypto circle. An unpriced catalyst on the team's clock. Now the honest part. Revenue is the crack in this story. $324 million over the trailing year, first place in its category, sounds great. But weekly revenue has decayed from above $10 million to roughly $5 million. The buyback is a percentage of a shrinking number. Daily active users are calmer, about 100,000 wallets, down from the February peak but flat for months. A floor, not an exodus. And then the anomaly. Transaction count exploded from a 10 million weekly baseline to over 125 million since July, roughly 8 times higher, while users and revenue stayed flat. Usually one of those lines moves to meet the other. Which one is the entire trade? Let's check the timing on the chart. Daily time frame. Those orange dashed lines form a falling wedge that compress price all the way through 2025. On July 19, price broke out to the upside. That alone doesn't make a trend. Wedge breaks fail all the time. What matters is what happened next. Quick note before the levels, since Pump trades at fractions of a cent, I'll call prices by their last digits. So 22 means 0.0022. Keeps us both sane. I anchored my Fibonacci from the May high at 22 down to the June low at 12. The breakout itself reclaimed the 55 and 100 exponential moving averages, the purple and yellow lines, in the same move. Then price pulled back and found support exactly at the golden pocket, the 0618 retracement sitting at 17. Textbook. Breakout, retest, hold. And now it trades above the 200 simple moving average, the green line, on top of everything. Full stack reclaim. A regime shift, not a bounce. Which brings us to the wall. 22. The May rejection zone, the cap that suppressed price all year. We're fighting it right now. My confirmation rule is simple. 2 daily closes above 22 without losing the level after. Wicks don't count. Closes do. Here's where whale logic comes in. The liquidation map shows long leverage below current price almost completely flushed, while short liquidation leverage stacks toward $20 million between 22 and 26, with the largest cluster near 24.6. The downside is deleveraged. The upside is loaded with forced buyers. One warning. The Heikin-Ashi Relative Strength Index on the daily is approaching overbought. Still pointing up, but a pullback here wouldn't surprise me, which is why holding the golden pocket matters so much. So here's my playbook. My strategic accumulation zone is the green box between 17 and 22, and I'm working inside it, not chasing above it. My invalidation zone sits at 16, and it requires a weekly candle close below. A wick changes nothing. Targets are the green circles. 32 at the 1618 extension, then 40, then 60. Risk management is a trailing structure. First target hit, invalidation moves to entry. Second target hit, it moves to target 1. I don't give winners back. Now the yield layer, because tokens sitting in an accumulation zone don't have to sit idle. The pump liquidity pools on Solana are printing right now. The top pump and USDC and pump and Solana pairs show APRs around 190%. Real yield from real trading volume, not emissions. The catch? The books are thin. The deepest pool holds under $2 million, so expect violent swings and real impermanent loss if pump runs hard either way. Small size only, a tool to compound while the range plays out, never a core position. Yield on top of structure, not instead of it. And if I'm wrong? If the weekly closes below 16, I wait for the Heikin-Ashi Relative Strength Index on the 2-hour chart to reach overbought, then open a hedge short, 1 or 2 times leverage only, targeting the red circles at 12 and below. Structure decides, not emotion. Everything reduces to one variable, revenue direction. The bull case is a supply shock funded by fees. If weekly revenue keeps sliding, the buyback bid thins, the burn becomes cosmetic, and this breakout likely fails at the cap. But if that transaction surge starts monetizing, shrinking supply meets rising buyback firepower, pushed straight into a $20 million short wall. Best case, we confirm above 22 and squeeze through 25 toward the first target. Worst case, rejection here and a weekly close below invalidation. Short term, I expect chop, maybe a pullback. Position term, the asymmetry favors patience inside the zone. My tell is not price, it's the weekly revenue bars on token terminal. One thing I've learned, supply shocks never pay you on your schedule, so position for the range you can defend, not the headline you read. If this gave you a real framework, a like and a subscribe helps. And if you want to trade this level by level, that's what the Pro Capital Vault is for. Inside the Discord, you get my real-time portfolio, the exact accumulation and de-risking zones on Pump, and every position I hold, weekly live strategy calls, the Sunday prep report, and direct access to me. Hit the join button below, use the link in the pinned comment and description, or scan the QR code on screen. Once inside, sync your YouTube account to Discord, and every private channel unlocks automatically. My question for you, would you trust a buyback funded by declining revenue? And what's your pump target? Drop it below, I read and reply them all. If you missed my most recent video, watch it next. The setups connect more than you would think. This is my analysis and my positioning, not financial advice. Manage your risk and let the chart decide.